there. This is Chris from thetraderguy.com, and I'm going to do a video on a couple of things that a lot of people will not talk about who are in the uh, trading guru or education business. And basically, the first thing you have to think about is when you look at a currency pair, what your plans are. What are you going to do with it? And this is about setting up the trade. This is about having more than just an entry signal and blindly entering the markets. Because quite frankly, I feel that the main reason that educators do not put much stock in teaching you exits is because quite frankly, it's where your money's made. If you don't know enough about exits, you will find yourself losing money over time. You have to at least have an idea of where the market could go and what to do when it reaches certain areas. So for example, if we would have taken this hammer right here on a buy signal, now for reasons that I'll show you in a second, 158 is a resistance area on this chart for me. This is cable, by the way. If we entered on a break of this candle, we would have known that at 158 there was going to be more than likely some reaction, and that's exactly what happened. Now, I also know, because of the fact that it was only about 80 pips, I wouldn't have been too thrilled about taking that trade. And in fact, even though in my technical analysis for a couple clients I said that the pair was probably going to 158, I also advised against going long because quite frankly I just didn't think the risk reward was there. Now, most educators will tell you that there's a couple indicators or something like that that may get you looking for the market. And then you see a hammer like this. Well, you put a stop just below the hammer and you enter the market. And that's as far as they'll say. And then what they'll do is they'll back test and they'll say, maybe the market goes up to about 161, then falls off. Well, what they'll do is they'll take that signal and they'll say, look, you would have entered here at 157 and a half and went up to 161 and you made all this profit. Well, the real world doesn't work like that. There are several things you need to know. In order to have a trade that's really worth anything, you need to have the entry. You need to know the stop loss as far as like when the trade doesn't work. You need to have targets or something I call hurdles. Now, those are the same things, essentially. A hurdle is just simply an area that you think may cause a negative reaction to your trade, but in the end should be overcome. Hurdles are only found really with the trend. So, for example, when you saw this trade go down, and you see a couple different times it held up as support here at about 154 to 155, and you shorted, say, off of this shooting star, beautiful shooting star, you would have known that that was a hurdle. Now, the reason I call it a hurdle is because of the downtrend and the fact that although it can come back up against you and slap you in the face, so to speak, it's something to be overcome. A target is more of a counter trend trade, or other times, if you happen to take partial profits along the way, then this might become target 1, target 2, etc. Again, I don't want to get too far into that, but what I want to do is show you how I look at this British pound chart and just kind of give you an idea of the thought process of how you may want to get involved or not sometimes. And I am doing this basically on the fly, so you'll have to give me a little bit of slack on this. But I want to show you the numbers that I used and why. Okay, here at 158, I put this, and I understand that 158 is a zone. You can see that resistance had happened several times there, and you can see the price had come down, it bounced up and went down, it bounced there, and it finally went over it. There's a reaction every time you come to 158. It started with this hammer here, basically, on this daily chart from what I can see. So that's an area to me that was obvious as we started rising up. As we were here, I'm thinking, okay, well, if we keep going, we know we're going to run into trouble, or at least some type of reaction there. 155 I have, just quite frankly, because it is the large round number, and 153 is a major support area. So on this chart I have 158, 155, 153. Now let me go ahead and zoom out to the weekly, and you'll be able to see a little clearer as to why. You can see that 158 has been reactive several times in this pair. That was massive support back here. I remember this time period very well because once we broke down, I wrote it down for 1,000 pips. It was one of the best trades I had had in the last couple of years. And based upon that broken consolidation rectangle, I remember it just was a wonderful trade. You occasionally you'll have a trade like that you remember, and that happens to be one of them. So, anyways, I have the 158 drawn out, and then I have the 155 because of the large psychological number, and you can see that it's been somewhat reactive, and then 153. And the reason I have 153 is, as you zoom out on the weekly, and I've alerted to people about this, you basically have a complex head and shoulders. 153 is the bottom several times over, and you can see it keeps reacting. So there's no magic to this. It's just a simple power of observation. My thinking was is that this head and shoulders breaks down below 153, we're going to go much lower to at least 140 based upon the measurement from the bottom to the top. Okay, so now we have our levels, and you can see why I use these levels. It'll make a little bit more sense. Okay, looking at the levels that I have plotted with the January 30th candle, which was a hammer, it broke above the 157 level, came back down and found support at 157. As you zoom in on this chart, you can see that 157 is the beginning of this resistance area. That's not uncommon. They tend to be, they're not just a line, they're going to be a zone. With that hammer, it does look very supportive. But again, I knew 158 was going to be trouble, so for my clients and for myself, I ignored it. Yes, I could have made 80 pips, but I let it go because the risk reward just wasn't there. So that's one way you can use the knowledge of the support and resistance in the markets to plan out a trade. By looking ahead like this, I was able to discern that this was going to be trouble. But let's just say for whatever reason I did decide to go long. Well, I would know that this would be a potential problem. Once I got above that, then at that point in time, I know that this should become support. It's just simple resistance becomes support and vice versa. The biggest thing with people who will teach you on the internet how to trade is that they will do things like they will say, okay, well, this indicator does this or this candlestick does this and you should buy, and this hammer is a buy signal, so you put your stop below the hammer and then you just kind of take it from there. If it goes below the hammer, you're out, and that's the easy part. It's easy to tell when a trade's working against you. It's when it's working for you that it becomes very difficult to manage it. You have to keep it under control. You have to be able to go ahead and let it ride if necessary. You need to understand when it's time to take profits. In this particular case, like I said, I didn't take the trade, but certainly if we would have broken down below the bottom of this hammer, it would have proven the trade to be wrong. That's pretty simple. But what happens is when I look at a chart, I want to know several things. I want to know the entry, I want to know where the stop loss goes, and I want to know where either my targets or my hurdles are. And hurdles to me are simply their support or resistance that's going against my trade, but I'm trading with the trend, meaning that more than likely they'll give way eventually. So it's something to overcome. A target, on the other hand, is normally, and there are always going to be some exceptions, but a target normally for me is a counter trend trade where I'm just going to take 200 pips because I can see that the market wants to give it up, and I take all of my profits then. Hurdles, on the other hand, I use as mileposts. If I can get past them, I'll move my stops up and try to protect them and go to the next target, or hurdle, I should say. So looking at this, we bounced off the 153, and I never got long this. I never got long this, and quite frankly, I could have made a lot of money, but I chose not to. And the reason being is I saw that 155 had a real shot at causing some trouble. And you can see that it did burst through 155 and it found it as support. Now, the Fed got involved somewhere around here and decided that they wanted to keep interest rates exceedingly low until the end of 2012, so that kind of created some extra juice. Events like that you really can't plan for, but nonetheless, as you saw the longer term chart, and you can see from here, it's not necessarily with the trend, and the longer I trade, the less I like trading counter trend. So now, looking at this chart, some things that I would think about when I saw it, if I decided to short it, is that we have an obvious stop out area, 158. Now, as far as putting a stop, I normally will put it at 25 pips or something above the round number. If it gets above 158.25, it's probably going to come get my stops. But when I look at this, I see this has been a pretty parabolic move. It's been straight up. It hasn't really even pulled back, and that's kind of unusual to shoot up 500 pips and have no pullback. When I look at this, I figure if the bottom of this hammer gives way at about 156.50, then we're probably going to go down to the next level, and that's 155. So if I decided to short for whatever reason, or I closed below that, or whatever I used to short, the entry isn't important. I mean, people use different entries, but I know that 155 is where the market is more than likely going to head to. And I know that if 155 gives way, we're going to 153. If 153 gives way, then that would be that head and shoulders complex being broken down, and for simplicity's sake, I'm just going to put 140. You have to think of the market as a simple A to B situation. Markets are perpetually doing this. They may jive around a little bit, but they are perpetually doing this, going between 2 points. No matter what kind of chart you're looking at, you're going between 2 points. The only time that that's not necessarily true is some type of meltdown, or if you're like all-time highs and there's really nothing to measure it against. But even then, you'll see reaction at large numbers like 1.25. So if you look at it and you have these hurdles laid out, you can put lines on the chart if you want. I choose to keep only the major ones and use the major ones for entries when I can, or a failed bullish signal becomes a very bearish signal. For example, this hammer. But as a general rule, I try to keep the big ones, and it simplifies a little bit. But as you look at this chart, I know I've gone over a lot, but you can see that I have a plan to begin with. That I'm not aiming blindly. I'm not just selling and saying, okay, well, we'll see where it goes. Or I'm not just buying and saying, okay, let's see what happens. Because the trader, and I'm sure there's some people out there who have done this, that saw this hammer and got excited, bought this. Well, if they got in just a few pips above the top of that hammer, and I'm not going to measure it right now, but let's just say it's 157.25 or so. Well, they're only about 28 pips up, and at one point in time they were 75 or so up. And they have to rely on this to hold as support. They will probably wake up in the morning and find themselves down or barely up. But looking at all these areas, one thing that you'll find time and time again is when you look at the charts like this, if you go to a long-term chart, and this is February 1st, so I'll look at the monthly chart, look what happens. That 158 becomes very obvious on a hammer on the monthly, and so does the 153. So this shows exactly how important these levels really are, even on the longer term charts. You can see that if 158, we go up to 158, that shows a continuation of the strength. And right now, I must say, it looks like it wants to support itself. But at the same time, if 153 gives way, that's a pretty significant deal when you're talking about breaking the bottom of this many monthly candles at the same time. So you have to look out ahead. You need to know where you're going. Trading is just like driving. You have to know your destination if you're going to get there safely. You need to know where you're starting, and you need to know when it's time to quit, and you also need to know where you're going. And I would also include in the going part, if I happen to short at 158 for whatever reason, just a blind touch, decided I wanted to short, this is my next sell signal. So for example, if we get below that, say we get down to 150, let's pull a random number out, 155.71. If we're at 155.71, there's absolutely no reason for me to take a loss at this point. And in fact, I would more than likely put my stop just above this last sell point. As we get below 155, I would put my stop just above that, and on and on. Um, the reason I'm doing that is because I'm going with the trend and I'm allowing it a chance to break free and to make some real returns. It only takes a couple of these trades to make a really good year. But as I continue to harp on, I had all of these levels laid out. So by all means, you need to know your support and resistance levels, and you definitely need to know every trade you get into, whether or not A, you have enough room to justify it, and B, whether or not it's with the trend, and C, what you're going to do when you reach a certain level. So with that in mind, I'll leave that for you to think about. But hopefully, this gave you something to kind of consider, and you can use it to expand upon your trading. Remember, I have a free Forex education site, thetraderguy.com. Absolutely no cost involved whatsoever, and I have plenty of videos on that which you can look at. If you got any questions, you can email me at chris@thetraderguy.com. Thanks for watching.